Hey everyone, welcome back to Corporate Decoder. Today we're diving into Star Equity Holdings' annual report. Get ready for some twists and turns because this company's financial journey is like a roller coaster full of ups, downs, and unexpected loops. Star Equity is a mixed bag of businesses, but the big story here is how they're shifting gears. They used to be in healthcare, but they sold that off to focus on building stuff literally. So how's that going for them? Let's find out. This is their official yearly check-in with the Securities and Exchange Commission. It tells investors everything they need to know about the company, good or bad. Star Equity calls themselves a diversified holding company, and they have two main parts, building solutions and investments. The first big thing to note is that Star Equity used to have a healthcare division, but they sold it off in May of last year. Now they are focusing on their building solutions division, which includes companies that make modular homes, wall panels, and even those big wooden beams you see in fancy buildings. The other part, the investments division, handles real estate and makes smaller investments in other companies. The company believes that this multi-industry structure allows management to focus on making good choices about where to put money, making smart deals to buy or sell businesses, and keeping investors happy. It also lets the people running each individual company focus on their own thing without getting bogged down in public company stuff. The company is trying to grow by buying other companies that fit with their existing businesses. They're looking at both small and large deals. They want to be smart about it and not overpay for anything. They have two main ways of making money, or what Wall Street calls reportable segments, building solutions and investments. This shows how the company is organized and how they track their performance. Building Solutions deals with everything about making houses. This segment makes things like modular homes, structural wall panels, and more. KBS makes modular homes. It's based in Maine and primarily serves the New England market. This company makes fully custom modular homes. That means they build homes in pieces in a factory and then assemble them on the building site. EdgeBuilder makes structural wall panels and permanent wood foundation systems. EdgeGL are based in the Minneapolis-St. Paul area and serve the upper Midwest region. TT makes glue laminated timber products, or glulam. These products are used in all sorts of construction projects, including farms, factories, and homes. The company holds real estate like manufacturing facilities that are leased to their building solutions companies. This division is also responsible for making investments. The aggregate market value of the voting common stock held by non-affiliates based on the closing stock price on June 30, 2024 was $5.1 million. This is a way of measuring the value of the company based on how much its stock is worth. For the year ended December 31, 2024, they had a net loss attributable to common stockholders of $12.5 million. This means that after paying all the bills, the company ended up losing millions of dollars. Revenue increased $7.6 million or 16.5% because they now own TT and Bailel, offsetting slower business at KBS and EdgeGL. In plain English, the new companies they bought are generating income, but other parts of the business aren't doing as well. Building Solutions gross profit decreased 7.2% because of fixed costs regardless of the revenue decline at KBS and EdgeGL. This means they're spending a lot on things like factories and equipment no matter how much they sell. The $574 to purchase price adjustment also hurt gross margins because it increased the cost of sales from acquired inventory at TT. The company reviews goodwill, an accounting term for impairment on an annual basis, or if events or changes in circumstances are looking bad. No impairment of goodwill was recorded in 2024. The company used $5.2 million to $5.2 million in operating activities, meaning they spent more than they earned compared to a positive $2.7 million in 2023. That's not good. The company used $12 million in investing activities as compared to making $16.2 million in 2023. This change relates to the TT acquisition offsetting cash from sale leaseback transactions. That means they spent a lot of cash to buy another company. Management believes earnings before interest, taxes, depreciation, and amortization is a meaningful indicator of the company's performance, but EBITDA from continuing operations was the loss in 2016. This simply means that in the company's view, they lost less money last year than the prior year. Of course, this wouldn't be a real annual report without a giant wall of risks to temper all that optimism, right? Let's see if there's anything concerning here. The company relies on IT systems and could be harmed by any failures, inadequacies, or interruptions in that technology, or if there were security failures. The company says health pandemics, wars, and inflation could disrupt their operations and impact their financial results. The company's operating results could be negatively affected by changes in costs and availability of lumber and other materials. The market price of company stock may fluctuate, and the value of your investment could decline significantly. If the company cannot continue to meet Nasdaq continued listing standards and other Nasdaq rules, its common stock could be delisted. The company says changing rules, public disclosure regulations, and stakeholder expectations on environmental, social, and corporate governance expose the company to potential liabilities, increased costs, reputational harm, and other adverse effects on our business. The company has anti-takeover provisions that may prevent or delay removal of current management or a change in control. Alright, let's put all this information together and figure out what's really going on with Star Equity. Star Equity is undergoing a major transition, selling off their healthcare business to focus on building solutions. Buying Timber Technologies and Big Lake Lumber helped bump up revenue, but some parts of the company are struggling. The decrease in gross profit is not good. The company has debt and may find themselves more exposed to risk if they can't borrow enough cash. From a numbers perspective, all of this looks bad. It looks like the company recognized that healthcare wasn't for them and decided to switch over to a booming sector. However, the cost might be too high. This is too soon to tell, so should you invest in Star Equity, I would personally pass on this company. Thanks for tuning in to Corporate Decoder. Don't forget to like, subscribe, and leave a comment with your thoughts. Until next time.